I'm pretty sure they probably like leaked information to the other companies somehow.
A bunch of other things that through our research, right, that we're doing through AI, extensively using more Gemini as well as ChatGPT.
In the peak of the hype cycle, they're able to raise 50 million with nothing.
Because I think that people are just as greedy as they are stupid. All right, guys, welcome back to another episode. Today, joining us is Enzo, of course. Can't fucking seem to get rid of him. And as well, special guest for us is David Kai from Proxima Investments. Just Proxima. It was formerly known as Kronos Ventures, and now they have just rebranded. I don't know, you probably give yourself a...
Yeah, formerly known as Kronos Ventures, we rebranded to Proxima to, do a broader scope of things. We were previously focused only on, ventures investing, and now we're, focused on the liquid side as well as advisory. So
Awesome. So now that we got the introductions out of the way, we can just talk. You don't have to stare at... Yeah, like, okay, hi guys. Well, stare at the camera, and your camera's right there, but...
Oh, there's a lot of cameras. All right.
Yeah, because they like clip it all up. Anyways, so we were just discussing like how you said nothing.
I was gonna say I know what happened in crypto. Is that what you're referring to, or is there something?
No, just in general. Well, you definitely missed the new release of Opus 4.6.
But that literally happened this morning.
Yeah,
It just happened.
I actually read about that too.
It just happened, and then on top of that, GPT 5.3. So OpenAI and Anthropic came out, launched within like 1 hour of each other.
Yeah.
So
Definitely, like, one saw the other and like, oh, let's press the go button.
I'm pretty sure they probably like leaked information to the other companies somehow, and then they're like, oh, they're coming out quickly. We need to get our stuff out like immediately.
So then I don't know anything. I know a little bit about 4.6. But can you tell me, like, why is it worth talking about?
I don't know. I haven't even tried them yet, but they're like, so they're
The only one.
they're the newest thing. But
Okay.
There's the contacts is up to like 1 million now
I saw that.
tokens or whatever. Even though it's gonna, I don't know anyone who's gonna be able to use that except for like super wealthy individuals or something.
The things that I saw about 4.6, again, I literally spent like a minute doing it or reading about it.
But by the way, how much do you know about AI?
A decent amount, but maybe not as much as you guys.
Has you been sucked into the whole craze lately? And
Of course. I mean,
into the whole.
a couple of things, right? If you look at the website that we built, that was kind of done solely through AI. The designing of this, right? It's done by people that weren't designers. There's a bunch of other things that through our research, right, that we're doing through AI, extensively using more Gemini as well as ChatGPT. Less so on Cloud Opus, but we're starting to, pick up the vibe coding. One of the things that one of our team members were doing is we're transitioning away from Slack to Google Chat, and he found a provider that was going to do it for, a few $100s, and then that kind of rolled into like a
Google Chat?
Yeah,
Yeah.
I'm not the only one. Yeah, okay.
Yeah, Google Chat's like doing something that's like a competitor to Slack. It's not there yet, but you guys kind of saw the evolution of Google Meetings kind of like replacing Zoom and all of this.
Yeah.
We think that there's a potential there. Doesn't really cost that much for Slack, but we're like, if we can make the transition now, what is the point of like retaining all of these legacy services, right?
So you guys focus on research, correct?
No, we focus on venture investing
Okay.
previously, but now we're focused on liquid investments as well as advisory, right?
Okay.
Research is an angle for us to get market knowledge about what's happening, right, in this amazing that we're investing in.
I'm kind of curious, like, what is your flow then when you use AI to do this? Because I've done research, but the extent of my research, like, go to X, type in the projects, and say, hey, give me like a deep dive into this. That's what I would.
No, you can do way more technical.
Yeah, like so.
than that.
Like what would you using a specific prompt? Or are you doing like an agentic workflow, or like what?
Oh no,
like?
I mean it's it could be like as simple as okay, if a founder is talking about a specific topic, right, digging into that specific topic and then learning more. It's like they're building something specific about so one of the projects that I spoke to literally is talking about compounding yield, right? It's like like let's loop to get to yield, right? And I was kind of doing research around that, and then what are the risks involved, right?
Wait a second. So you're talking about like Athena, like the people that were looping Athena over and over on Binance and caused like the huge depegging and stuff.
Yeah, something like that. And there's another project that's kind of like doing
What?
I won't mention them because we haven't invested. We're so diligencing. They're
holding bags.
No, we're not. No, we're not. And I think the founder is, quite interesting. But what you have to really study is with a lot of these things, right? You look at the overall yield. The yield is compounded on the looping, right?
Yeah.
But what is the actual risk of your collateral? Like after that loop, right? What is the actual risk of the collateral? And
But you know what shocks me? Well, I guess it doesn't really shock me because I think that people are just as greedy as they are stupid. But what somewhat still shocks me is that we see things like Terra Luna. Everything that happened there, which is pretty much the exact same looping disaster that caused the 2008 housing crisis, and then we do it again and again and again. It's like the market never ever ever learns from their history.
It's I think there's some difference, right, between Luna Terra and some of the structured products. I consider Ethino almost like a structured product, right? Because you're betting on funding rates going in one particular direction, which is not the direction that it's like we're seeing right now with overall state of the markets, right? Luna is 100% a fabricated currency with no collateral, right? The value was completely, sustained by people pumping the value of the token. There's no collateral. Like you look at USDT, you look at USDC, right? That's quote unquote fully collateralized, right? And there's a basket of assets. Well, most of the assets are, liquid, treasuries, over different durations.
Yeah, but they don't essentially back themselves with leverage in the sense that they just loop over and over in order to sustain themselves, with Athena or with a bunch of other stable coins. When the looping structure happens, the problem is that the market cap gets way too high. There's too much exposure into the market, and then when the liquidations happens, it depegs. And as soon as it depegs,
it's cascading liquidations.
Yeah, a stable coin is only useful if it's stable. You're only as good as your last trade. So if it depegs and the people lose trust in it, essentially, then you're gonna have a fundamental crisis.
Yeah, I mean, the problem with Luna was they had, I won't mention any names on the market makers, but I think the guys in the space know, right? They had a really, really big market maker defending their pay, but when the losses, a certain amount, no, it's very well known. I don't want to mention the, you know what I mean, right? And Target, right? But when the losses were sustained, right? They were like, all right, we're just gonna let it defect. But then this is like the death spiral happened instantly, and the crash was like instantaneous. I think it went from started depegging a little bit, but then it basically the inflation of Luna was ridiculous, right? To death spiral.
So
really quickly,
what did you call it? Compounding something? What was your term?
Compounding yields.
Compounding yields. What is the difference between compounding yields and restaking protocols? Or is it the same?
No, different.
How?
What restaking would be something it's kind of similar in the sense that they're basically compounding to get more yields of whatever token, but it is the difference between compounding yields on Ethereum and compounding yields on a stable coin. The key word is stable. Stable coin is supposed to stay stable, and the biggest problem with a lot of this stuff, especially the stable coins, is that people get into stable coins expecting that it will keep its peg.
Yeah,
and then they use that and loan it out, and they essentially leverage that over and over, not just to compound yields, but also for all sorts of other projects. That's how you get contagion effect, because then everyone else starts losing all their money on all these other projects, and that's what really causes the majority of the damage. If it was just, if Terra Luna just went down and it only killed Terra Luna and there was no contagion effect, that wouldn't really be that much of a problem. We would just see it on Twitter like, oh, look, this token blew up, somebody rugged, and that's pretty much it. But the problem was that there was too much exposure into the rest of the market using Terra Luna, and all of those companies collapsed alongside Terra Luna. That was the main problem.
I'll ask about restaking, because the same sort of risk is involved in restaking, right? Where I stake here and they can't give me my deposit, so then the next person can't get it.
But it's not as common to see large institutional players and just to see a large amount of third party loans of a of Eigen layer, for example, for their core business structure because everyone knows Ethereum is not stable. It is highly volatile.
So the
Right.
stable aspect allows them to do this in a
Well, the stable
safer environment.
exactly. The stable assets is what tricks them into thinking, okay, like this will be stable. We can, add leverage with this stable coin because it's not that much, right? Like we can pull out loans with the stable coin and blah 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 blah. But when the stable coin starts to crash and then like their loans and all that other stuff goes out of whack, that's what really causes the problem. You don't really see that many people, especially large companies and like exchanges and stuff, pulling out a bunch of loans on Ethereum because they know it's highly volatile.
And you've looked into it. Do you agree that this is a risky thing to do?
Yeah, so maybe I go and I talk a little bit about what does it mean to kind of compound, right? Like, so let's say you find a protocol, right? And there's a difference in yield rates and borrow rates between USDT and USDC. And then you can go and you can supply like USDC and then and I'm making this up, but supplying and then as one instance, right? You can supply USDC and then borrow, the supply rate and the yield rate, right, is actually, and this won't happen many times, right, is actually, higher than the borrowing rate, right? You can loop it where you supply, you get the yield, you borrow up to the LTV, and then you convert, like, let's say that you borrow USDC, you convert it back to USDT, and then you resupply, right? I'm not saying that this will work because there's, like USDT and USDC are very safe assets, but there's other assets that are less safer. But the point here is this whole looping game is predicated on the peg balance between USDT and USDC. These are two safe assets. It's going to be pretty well pegged. But what if it's like, USDC and another stable coin, right? Mm-hmm. And that other state, you have to look at the risk of that other stable coin because if it starts depegging, right, and you looped it many times, let's say depegs like 5%.
Let me get to lower the risk.
Essentially get
lower the risk to lower the reward, I would guess, right? So you are taking on more risk in order to get these higher returns.
Correct, because the looping basically is adding leverage where the a less amount of the depeg will cause you to kind of get.
But this loop is only possible on pegs that are not USDC, USDT. It's some USDT and something else, and the risk is that something else.
Yeah.
But the problem of like these yield compounding stuff is that a lot of people think that, okay, because it's a stable coin, that it's a lot less risky to do these things, when that's just not true. Not in crypto, right? Like it's something in like maybe in the traditional markets it would be a lot safer, but in crypto we've already seen a collapse. So
one of the biggest examples, this alludes to what happened during Luna Terra, right? A lot of people were converting over to UST, which is basically a Luna Terra stablecoin, because they were able to farm UST and get a 20% yield on Anchor Protocol. They didn't really understand how the yield came about, right? And then so they were like, oh yeah, we can get 20% yield. It's UST is also a stablecoin. It must be like USDT. We're gonna get a 20% yield, but they did not take into account, or the retailers did not take into account, the principal loss risk, right? Of of essentially an unsafe asset class, right?
So then
they did the same with BitConnect,
So then you as an investor, why would you invest in one of these companies if that risk profile is so high?
Well, we don't, right?
Why would you consider it, at least?
Why would we consider it?
It sounds like you're considering these
protocols. So
they sound high risk, at least
absolutely
long term.
High risk. But a lot of times when protocols do really well, let me ask you this question, right? When you look at Luna Terra, ultimately failed. Yeah. But during the process of it getting built up, right? The amount of traction that they got for their ecosystem, you cannot deny that. But ultimately, right, it was built upon a system that was smokes and mirrors because there's nothing defending kind of USD outside of like, what is it? It's they're building an ecosystem, right? There's no backing for Luna Terra. But then if you're on the Luna Terra side, right, they can make the argument that, okay, what is actually backing Bitcoin, right?
Well,
what is
US dollar?
Exactly. Right? What is actually backing the US dollar?
Mm-hmm. Well,
I was going to go
America.
Well, 50 years ago, you could say that gold was backing the US dollar.
Yeah.
But after that, right?
What is nuclear weapon?
Exactly. So going to that point, right? How much does the US government spend on military every single year? I think it's like $700 billion. That is more than the sum of the number 2 and the number 10, right? Added together in terms of military spending. That's very valuable because.
And how does this relate to this compounding of stablecoins?
It relates. So to your point, right? Like, so you look at the Luna Terra ecosystem and all of this, right? They can say that, oh, we built the ecosystem back and defend the peg. Is that ecosystem big enough? Can that collapse in 1 second, which it did, right? And that was the case.
And so you're looking for protocols that have this compounding cycle built in, but also are stable enough or have enough traction that they can weather any sort of storm. Was that the argument?
Yeah. So if, for example, if a project has a really good go-to-market and can build a lot of adoption and all this stuff, but evidently, when you're looking into like the model they're design, right? There's like Ponzonomics, or it's like, oh yeah, we're gonna create a stable coin, and then there's no collateral with the stable coin, right? It's not something that we want to back, because there is a chance that they can get a lot of traction in the interim. But if you look at the duration for the whole business profile, right, it's unlikely, right? And a lot, some of the VC funds, right, that backed Lunaterra, a lot of them didn't sell at all, right? And if you look at it, if they ride the up and the down, the gains are only on paper gains, right? Ultimately, it was a loss, right? And this fundamental belief really came because, if you look at my background, right, it was more traditional finance. And I'm not saying like, there's multiple different sides of the equation in terms of, do fundamentals matter? Is it more of, a traction game, right? It's a combination of all these things that kind of leads us to, hopefully the correct decision about whether or not to invest in a project.
Okay, so let's dive a little bit more into your world of like investment stuff. Like, I always have not constantly, but like very often, people always messaging like, oh, they're trying to raise funds, they're trying to, they want to build something, blah, blah. What would you recommend for these sorts of people to do? Like, let's say he wanted to build something and raise some funds. Like, what tips would you give him to make the pitch more presentable for people?
Yeah.
I think a lot of people would like to hear that.
I think the first thing is you have to holistically think through your whole business model and think deeply, right?
What the hell is holistically think?
Meaning if you're basically focused on tech, right, and you only think about tech, then we're going to diligence that. We're going to be like, okay, this guy's tech focused, but have you thought about the go-to-market? Have you thought about the marketing? That's the holistically as a whole business, right?
Can we pause on this specific?
Sure.
Even though it's the first one.
Sure.
I totally agree. Like, doing financial projections, really, really important. But at the same time, if you're going to do financial projections on something that's non-existent,
So for the stages of projects that we are investing in pre-seed and seed, right? We don't care about financial projections because they're all complete. They're not
exactly.
Yeah, it's all. Yeah, let's be serious. It's all bullshit. That financial projections.
Yeah, things about it hypothetically.
Yeah, financial projections are much more prevalent in later stages. Let's say that it's like a Series C or D, but we were only focused on Series C or D.
Yeah.
And then in my previous life, right, in private equity, financial projections are much more valid because a lot of times you're investing in businesses that, I think 100 in private equity, right? 100% of the time you're investing in businesses that are like revenue positive, right? Some of the time you're investing in businesses that are like, income positive, or it's turnout situations.
So you're not just investing in a roadmap
or a white paper.
Yeah. So
White paper roadmap. Is that what you're talking about?
No. Financials are different than a roadmap.
So when you say holistic, then my next thought goes to white paper and roadmap.
Sure, but white paper and roadmap. But what I'm saying is, if you are a tech-focused founder, right, and you just focus on the tech aspect of this, right, but you don't really consider how to think about the go-to-market and all this, right? Well, that's a negative, right? And this is why the team is important. If it's a solo founder, and the founder doesn't have like the go-to-market side, does he have someone on the team that can cover for him, right? Have the team been working together for quite some time, or is it a newly flushed team, right? And then sometimes there are projects where one day they have one person on the team, and then like a month later the team switches. That's like not great, right? That's like a red flag, right? I don't think it's a red flag when the ideas keep iterating, and there are a lot of projects that we invested in where when we invested it was a totally different
They
idea.
keep pivoting because of the market or
Exactly, and but that's kind of like as a founder you should always be thinking about how to pivot, right? But the key is when you talk to a project, you're like, okay, have they really thought about the idea deeply? Where I think as a VC, right, you have you kind of have a general knowledge set about many different things, but you can poke holes into like, okay, are they detail oriented enough where they thought about this, they thought about that, right? And then you say, okay, have they thought about who their competitors are, how they are going to attract market share? And then, okay, have they thought about what are their barriers to entry? Is that strong enough? Okay, have they thought about how are they going to go and capture that slice of the pie? What are all the areas, right? Okay, are they reasonably well connected? And finally, like when you kind of DD kind of their name and their background, right? Does it come up as clean, right? We don't really want anytime.
Don't search up my.
It's all good. When a lot of times, right? Everything went well, but then for example, if a founder worked at a place that was like pretty well, and then we have connections at many of these prominent places.
I feel like that's such a trap right there, though. I see it so often where it's like, oh, this person raised a bunch of money because they were working at like FTX or they were working at like whatever, and then it ends up being like a trap. Like they perform just as well as everybody else, which is bad, right? So I feel like VCs in general are really bad at that. They make their decision mostly based on the network effect of like, oh, I know this guy because he worked over here, so he's good, he's smart. But then that ends up biting them in the ass.
I think some VCs may do that, but for us,
not
right?
me.
No, but for us, we pay more attention to the whole holistically, right? One of the aspects is you have to look at the network effect. Are they well connected and can they leverage their resources on connecting? But you also have to know, at least, so the idea can be a B idea, but how deeply did they think about the B idea in terms of like thinking through all the competitors, in terms of like, how much have they iterated or executed on it, right? Because that gives you a sense of, okay, it's a B idea now, but if they pivot on a dime, can they do it with a new idea? And if they can do it, then we're like, all right, we believe in this, we believe in this theme. There's many aspects of getting the VC business right, and we're learning every single day.
The VC business is this kind of you're looking for a moonshot, right? So you're trying to sprinkle investments across a bunch of people or a bunch of projects, and you kind of expect the majority of them to fail. Just you're hoping for the one with outsized returns to cover everything else. And so I say it's because like just looking holistically really gets you that moonshot. I feel like a lot of the moonshots, they won't look good on paper. There'll be these ridiculous ideas that when you put on paper, you're like, oh, that's never going to work. But those are the ones that make the most money. So if you're looking for those moonshots and then you're looking at the holistic things with a nice business pitch deck, Because he thought it's conflict.
Yeah. So let me when I say holistically, right? Maybe it's a definition of like how is holistically defined, right? Holistically doesn't mean they have a nice pitch deck or any of this stuff. Holistically means is the founder or the founding team well-rounded enough to tackle all of the challenges of a business, not just one aspect, not just kind of like the tech aspect, not just the marketing, not just the BD aspect, right? Can they go out there, build a product, and can they go and market the product, right? And actually get users to come on board, right? What makes you convinced that they're able to do that? And that will make me convinced that these guys will basically have an outsized chance to, make it big. The other thing that I want to invest in outsized shots, and I agree with you on that, right? And I also agree with you that for almost all VCs, right, the majority of the investments do go to, our money losers, right? Yeah. However, it's not like, oh, you invest in 100 and one basically comes out and starts making money. If I'll give you an example. If we invest in 100 projects and maybe 10 or 20 makes you money, but that 10 or 20 makes you, like 10 to 20x, right? That's still like, 2 to 3x your fund, right?
Yeah,
you just have to basically look at your, risk reward. Because if your entire fund is predicated on making 100 investments and betting on that one that will basically, return everything for you, what if you don't invest in that one, right? Like, you're kind of like,
So so this is actually something that I was thinking of asking right now, of interjecting with.
Yeah.
What would be your strategy for this sort of stuff? Because I was doing a lot of angel investing as well back in the previous cycle. Now, never ask me for money again. Like I'm never investing again on that stuff. But a lot. I've talked to a lot of different angel investors before, and like try to pick their brains to I guess min-max the like R&R. And what I was kind of doing, I've heard from like all sorts of different people, and I don't know which one's the best strategy, but there's essentially two main things, right? You do due diligence, you save your money, you find until you find one that you really like, and then you go heavier into it. So basically a smaller portfolio, but bigger exposure to each one, and just doing like hardcore, like being very, very picky with your investment.
Yeah.
Or is the, spaghetti effect. You grab a bowl of spaghetti, throw it at the wall, see what sticks, which is like, you invest in 100 and like one of those or, a few of those will actually be moonshots, and then that's where you make your money. So like which one do you think is a better strategy?
So so this is very, very interesting question, and I can tell you kind of like through our evolution of our VC fund, we actually shifted from one focus to another. In the very beginning phases of our VC fund, right, we were more of like, okay, let's just invest like small ticket sizes into a bunch of projects, right? And hopefully like, one.
That's the spaghetti effect.
Yeah, that's it. Yeah. That's basically like, the spaghetti, as you talk about the spaghetti effect, right? as we started to evolve more, right, and as our sourcing channels for deal flow, right, started to get better and better, and we had access to pretty good deals, and our network started to kind of broaden, right, we realized, okay, we can add value to a lot of our portfolio companies, but if we have like 50 or 60 or 70 portfolio companies because of the the spaghetti strategy, right? We're going to be so scatterbrained, and it's going to be so difficult for us to kind of focus and help individual projects that we really want to help out on, right? And then we started really focusing our investments, concentrating ticket sizes, maybe investing as much as 10x our previous ticket size, but then actually helping these projects out, you know.
I feel like a lot of VCs did that. I feel like a lot, not just VCs, but angel investors as well. Like over time, before it was just a spaghetti effect. Like during the bull market, everything sort of wins, right? Like in the beginning of the cycle, everything sort of wins. Everyone has money. Everyone's just throwing money around everywhere. And then as like the market matures, you just have to be like more and more picky or something. But I believe that it's not just you guys that did that, started doing that, but like everyone else started doing that as well. And I guess it's good because then you don't have so many projects now. Like, I guess it's kind of good and bad because you don't have so many projects out now, which a large majority of them are kind of scammers. Let's just put it out there. Like, let's just call it for what it is. They're just raising money because they think, oh, it's easy to raise money, and they just rug, right?
Yeah.
And then so the good thing is that there's not so many of those. But the bad thing is that all of the like people that do want to build something real and like try to innovate is a lot harder for them to do that.
Absolutely. And it's for us, right? It became easier and easier to identify scammers, right? If you look over the course of the last 2 years or so, there were many cycles where there was a narrative at play. Whenever that narrative was at play, there's a universe of new project basically building upon that narrative. So, for example, when there's a Bitcoin layer 2 narrative, right? And then after the Bitcoin layer 2 narrative, there's like an AI agent narrative, right? We, across all of these narratives, right? I would say that there's a much greater percentage of projects that you talk to that are like scam projects, right? That are targeting those narratives than not, right? And so therefore, like out of all of those narratives, right, we invest in very little. For the BTC layer 2 during that narrative, right, we invested in one company. And then there's a company that we invested in way before the narrative even took shape, right? That shifted into that narrative and actually did, pretty well. And also, before all of the BTC layer 2 and the other thing, there's another narrative that was a GameFi narrative, right?
Play to earn.
Yeah,
I think GameFi is gonna make a comeback though. It seems like if you look at somebody, I saw an article, like some research article recently, that it showed the user base of like all of like DeFi and like crypto in general, and it's just completely plummeting. And then it shows the user base of GameFi, and it's slowly crawling up, way above the user base of everything else. So, I mean, maybe like the volume and the hype isn't really there because it's more like in the back end of these games now, but it definitely seems like it's growing.
So yeah, let me kind of go into GameFi and why it was kind of like what I think it was short lived, and why it didn't really sustain. I think when we go back to the GameFi days, right? I think you have to credit Sky Mavis team and Axie Infinity, right, are really driving that narrative and building like a massive ecosystem, right? People in Southeast Asia during the time of COVID, right, it was an opportunity for them to actually make more money than their jobs, right? Because they were able to farm the Axie Infinity game, right? And I think that was amazing, very, very good. What my biggest issue was, and I'm a huge gamer, right? I'm a gaming nerd. I understand how game design is, right? My biggest issue was, if you come from the lens of a gamer and you talk to a lot of these GameFi projects, right? Fundamentally, the games that these guys were building, right, were, from a game design perspective, either didn't make sense or it's not fun or it's not well developed, right? And the valuation that they were raising at was absolutely ridiculous. And the reason why they were able to raise at those valuations was, because of like the whole everyone was focused on GameFi. I mean, I'll give you an example. There's and I won't mention the name of the project, right? There was a gaming project that was raising at the height of at the height of the GameFi, I think it's like November 2021 or like late 2021.
Oh, yeah.
Yeah, or beginning of 2022, right? They were building like an an action RPG game and ended up, I think, raising.
I think I know what you're talking about. Wasn't there like an SBF connected one?
I won't mention the beats, right? Like,
Okay.
but I think these guys ended up raising like 50 million on a 500 million valuation
Jesus.
with no, like, I don't even think like a playable demo of the game.
Didn't Arc Raiders come out and they only cost like 25 million to make it or something, and it's made like over 500 million dollars, something like that. Like to see these GameFi games, and also just not even not just GameFi, but like, I mean, even just like GTA 6, like the amount of money that these games are spending is insane.
I'm gonna allude, right? So Arc Raiders is one, right? I haven't really dug into it. Was Arc Raiders an independent studio or?
It's a semi indie. It's like a very experienced he did I forgot who he was, but he was like one of the guys that made like some other thing, and then he created his own game studio, and it was like just like a small team of like 30-40 devs or something like that, or whatever.
So the comparable story, right, was also there's a game called Expedition 33 that year, right? So and this is, like, if you want to talk about indie game developers, right? That was done by an independent game studio. It was a guy that didn't really like his job at Ubisoft, left.
Yeah, so kind of similar story with Arc Raiders as well. Yeah.
Left, got like a ragtag team of people. Like, for example, like the person that wrote the story for Expedition 33, right?
Was like a redditor.
She was hired in to do like voice acting for something, but then like when you look at the story, it's like fantastic. And then the person that was hired to do the music, and the music was great, right? Was like some random person.
Have you actually played the game?
Oh yeah, I'm a gaming nerd. I know the game mechanics, and I know the
one of my favorite games. Such a great game. You got to play it, man. It's really good.
I love the idea of games, but I don't actually put time into them.
No, but it's like a man. You watch movies?
I do, yeah.
So it's the same.
Did you finish it though? Did you finish?
Fuck yeah, man. I even.
Are you in New Game Plus? I'm in New Game Plus. I mean,
nah. I don't. I already know the story, so I don't want to like redo it. Right? It's the same. Like
I play based on the mechanics of the game.
No. I'm a completionist, so I literally complete.
No.
Everything.
If you're a completionist, you would be on New Game Plus.
Have you killed Simon?
Dude, there's in the new patch, there's an ultra upgraded version of Simon. I killed the upgraded version of Simon in New Game Plus.
No, my new obsession is Cloudbot and like to give it live coding. So go back to what you're saying though, okay? The reason why they're able to raise this much money is because there's these hype cycles, and like you said, in the peak of the hype cycle, they're able to raise 50 million with nothing. So my question would be is like, okay, you were talking about this idea of like investing in the team and products that you think can pivot and succeed. And you guys invested in a Bitcoin ordinals program or something, or
Bitcoin layer 2. Layer 2, yeah. We invested in during that time, or we invested in BitLayer.
So my question would be like, so if you invest in them through in a Bitcoin layer 2 and you hold through that peak all the way down, aren't you back where you started? So isn't it better just to try to be catching those waves and try to get that 50 million and then,
So, absolutely. But then, is it easy to basically catch what the wave of the next cycle will be when like, so for example, you're right. One of the points that you mentioned is when you make an investment, right? Typically it takes like 1 to 2 years before the token actually gets listed, right? Typically that's like a 1-year lock, and then it's like a 2 to 3 year vesting, right? So by the time that you're actually, exiting the investment on the vesting cycle, that's many years out. And then typical like cycles or narratives for these crypto projects, right, are probably in like a 6 month duration.
Yeah.
But then should you be chasing after the narratives, or should you just be fundamentally betting on strong teams that can think many different angles, right, and they can pivot into the right narrative at the right time? So one of our portfolio companies, Solve, right, did something totally different. And then when the Bitcoin layer 2 narrative came about, right, they pivoted into that, and then got a significant amount of TVL, right?
One thing that I realized though now is that when a lot of people say like, oh, the seed investors or the VCs, they're dumping tokens on us, blah blah. A large majority of the time, they've already sold through OTC before the vesting even unlocks. So usually the people that are dumping tokens are like the OTC buyers of those people.
So just because it's vested you can still sell like your stake
Yeah,
yes to
of
token.
course. Why not?
Oh.
It's the same thing like selling
Oh,
points
you'd
on the
be sell-
airdrop.
You'd be selling your wallet address and they connect it and claim it or something.
Yeah. I think what you say is, VCs look at that. But I don't. It's not as common as you think in terms of a lot of the OTC deals. And I'll give an example. Like to facilitate an OTC transaction, right? A lot of times, because to get comfortability for the buyer, they need to have a contract reassignment. Meaning, if there is no contract reassignment, there is a liability where, if we're a seller, we would have to deliver the tokens to us, and then we are a counterparty risk. They'd rather get it directly from the company. But then what that means is the company knows, right? And sometimes that's not really great. If you're a VC investor, you're supposed to be holding on for the long run, right? Why are you deciding to kind of sell your position? But then, there are companies who understand what we have done, and, we formulated relationships, and, we have done some of these OTC deals. But that's more of like, I don't think it's like, that common, because ultimately when we want to invest in a VC project and all this, right, we're betting on an execution over the life of the project. Right, which is like,
Yeah, but then 4 to 5
years.
Well, VCs, you still need liquidity, right? So if they're up multiple X on their investment and they have a buyer who's willing to buy out their like vested, then they get more liquidity so they can just invest into new projects. That's usually how the cycle goes.
Well, it depends on how the VC fund is structured. A lot of the traditionally structured VC funds actually don't care about that, because the way that they get liquidity is they set a fund size, right, and they start calling capital to deploy, right. I need to deploy. It's not like I've monetized a position because I've did an OTC deal, right? I need capital to deploy. Oh, I go to the universe of my committed investors. I said, okay, I need to call your capital. Give me your capital, and then invest, right? And then that becomes a vintage, and then that vintage, when the capital gets returned, right, they just return it back to the original investors. So it's not like, oh yeah, if you're a true VC fund, right, that you need to do something, but this would be the case if you're like a liquid fund, or if you're like a hybrid fund where you can take your capital back and then redeploy that capital, right?
Yeah, that's right, guys.
Yeah.
Can I direct the topic towards something that we both love, which is AI agents? Sure. My theory is that the next huge crypto wave will be this recombination. We've already had a crypto AI wave, but I feel like it was too early. At that time, these were like X agents, and they all sucked. It was a complete waste of time. But I think now things have actually.
It was basically smoke and mirrors. It was just
But
like
now, like Claudebot was the first example. It's still smoke and mirrors, but it's closer to being a real thing. And so I guess my question to form into question would be like, have you seen any good crypto AI agent projects recently?
I have not.
What are your thoughts on it, just in general?
I think it's too soon.
It is. But I think that this will be when these two things come together.
I think it's definitely going to be a narrative. Yeah. Anyways, a very interesting discussion today. Thank you guys for joining. I think we should wrap this up. It's already, I think, past an hour, right? So
Oh shit!
don't want to make it too long for the guests. But thanks for joining us, David, Enzo as well. And
Absolute pleasure.
maybe next week we can just continue on. Yeah.